You know, market crashes, they create so much panic, and they can absolutely destroy fortunes. But for Warren Buffett, they're the ultimate buying opportunity. So let's break down his crisis playbook, how he not only survives financial chaos, but actually uses it to make some of his most legendary investments.
This quote right here, it's pretty much the foundation for everything. It's all about mindset. See, while most people see a falling market and their first thought is danger, Buffett sees something else entirely. He sees a massive transfer of wealth that's just about to happen, and he's just positioning himself to be on the receiving end.
Okay, but being patient is one thing when the market just, dips a little. What do you do when the market really truly breaks? When the entire system feels like it's on the verge of total collapse and the panic is so intense it feels like capitalism itself is ending?
So we're going to look at two moments where pretty much the whole world thought the game was over. First up, the sudden, shocking crash of 1987. And then we'll jump to the systemic meltdown of 2008. These are two very different crises, but as you're about to see, Buffett applied the exact same core strategy to both. So let's start with our first case study. The year is 1988. We're in the shadow of a historic crash, and Buffett makes this move that seems, completely out of step with all the fear gripping Wall Street. What does he do? He buys a soft drink company.
Look, to really get his mindset, you have to appreciate the absolute terror of that day. Can you imagine waking up and seeing that the entire market has lost nearly a quarter of its value in a single day? People were liquidating everything. They were completely convinced a new Great Depression was starting.
And this, right here, just brilliantly illustrates the difference in perspective. While everyone else was looking around seeing burning wreckage and financial ruin, Buffett was scanning the horizon for survivors. He was looking for businesses that were so strong they could withstand literally any storm. Now, you have to remember, Buffett's original training came from his mentor, the great Ben Graham, and it was all about finding statistical bargains. Graham's whole method was kind of like searching for cigar butts on the street. These discarded companies that had just one last free puff of value left in them. The goal was super simple: find something cheap. But, Buffett eventually realized something. He realized that cheapness could be a total trap. A cheap company is often cheap for a very good reason. He was evolving beyond just being a bargain hunter. He was becoming a hunter of true quality. So he shifted his focus. It wasn't about cheapness anymore. It was all about this: quality. Why buy a struggling cheap company when you could buy an absolutely dominant world-class business, especially if a market panic is offering you a temporary discount? And Coca-Cola? It was the perfect example. It had what Buffett loves to call a moat, this huge, durable competitive advantage, like a castle wall, that's almost impossible for competitors to breach. He saw it as an inevitable product because, look, crash or no crash, people were still going to drink Coke. In his mind, the market crash didn't damage the brand one bit, it just put it on sale. So he didn't just, nibble at the stock. No way. He backed up the truck. He poured $1 billion into Coca-Cola. And you have to remember, back in 1988, that was an absolutely colossal sum of money. Now, what's really wild is the sheer concentration of this bet. This wasn't some small, diversified position he was taking. That $1 billion, it represented over a third of his company's entire stock portfolio. This was an all-in move, based on pure conviction. And the payoff? Well, the numbers kind of speak for themselves, don't they? That $1 billion investment is now worth over $25 billion. But look at that middle bar. That's the truly staggering part. Today, Coca-Cola pays Berkshire over $700 million every single year just in dividends. The annual cash he gets back is now 70% of his original cost. It's just incredible. All right, so let's jump forward 20 years and see how this strategy evolved. The storm that hit in 2008, it was way, way darker. This wasn't just a stock market crash. It was a crisis that was threatening to bring down the entire global financial system. And this time, Buffett wasn't buying a soft drink. Just look at the speed of this collapse. It was terrifying. Bear Stearns was gone in March. Then, in just 1 week in September, Lehman Brothers goes bankrupt. AIG needs a massive government bailout. The historic pillars of Wall Street were either gone or on life support. The credit markets were frozen solid. And in that environment of total, absolute panic, Buffett's phone rang. So who's on the other end of the line? The CEO of Goldman Sachs. The bank was bleeding cash, and maybe more importantly, confidence. They needed money, for sure, but
What they really, really needed was a signal to the world that they were safe. They needed the Warren Buffett seal of approval.
And this is where it gets really interesting, because Buffett understood his leverage perfectly. He didn't just buy their common stock, oh no. Instead, he demanded $5 billion in preferred stock, which put him first in line for any payments and guaranteed him a massive 10% dividend. That's $500 million a year, no matter what. And as a sweetener, he got free warrants, which gave him the option to buy more stock cheaply later on. He was going to capture all of the upside if the company recovered, with very little of the risk. The brilliant part of this whole thing is how he structured the deal. He got paid handsomely just to wait, and he still captured that massive upside when the panic finally subsided. Once Goldman got back on its feet, Berkshire walked away with over $3 billion in profit from this one masterfully constructed deal.
And this was actually the headline of an op-ed he wrote for the New York Times during the absolute depths of the panic. This wasn't just an investment in a bank for him. It was a bet on the resilience of the entire American economic system. He truly believed the engine had stalled, but it wasn't fundamentally broken.
Okay, so how on earth do we connect these two stories? A soft drink company in the 80s and a giant investment bank in 2008. Well, it all comes down to a single, really simple mindset.
This lays it all out so perfectly. In '88, the asset was a global brand, and his tool was just plain old common stock. The bet was on enduring quality. But in '08, the asset was the financial system itself, and the tool was a much more sophisticated private deal. The bet was on systemic recovery. You see? Different tactics, but the exact same core philosophy. Use widespread fear as your entry point.
You know, this might just be the best analogy for his entire approach. He said that if you plan on buying hamburgers for the rest of your life, you should be rejoicing when the price goes down, not panicking. And he sees stocks the exact same way. A market crash is simply his favorite companies going on a huge once-in-a-decade sale.
And really, that's the ultimate takeaway here. True crisis investing isn't about trying to time the market. It's about having the conviction and the guts to act when everyone else is paralyzed by fear. So the real question isn't if the next panic will come, but whether you'll be able to see the opportunity hiding inside of it.